Good morning. Welcome to Top of the Morning by Mint, your weekday newscast that brings you five major stories from the world of business. It's Thursday, February 27th, 2025. This is Nelson John. Let's get started. Over the past 3 months, at least 10 Indian states have held investor summits, now pitching themselves as the next big business destination. From Rajasthan and Bihar in December to Odisha in January and a flurry of events in February, including West Bengal, Karnataka, Kerala, Madhya Pradesh and Assam, states are in a race to attract capital. If government claims hold, these summits have generated massive investment commitments. Rajasthan leads with 35 trillion rupees in MoUs, followed by Odisha's 16.73 trillion rupees and Karnataka with 10.27 trillion rupees. Even states with weaker industrial bases like Bihar and Kerala have drawn 1.8 trillion rupees and 1.53 trillion rupees respectively. In total, these projects could create over 2.5 million jobs if they materialize. States have also taken their investment push global. At the World Economic Forum in Davos this January, Maharashtra, Andhra Pradesh, Telangana, Uttar Pradesh, Tamil Nadu, Kerala, West Bengal and Karnataka have pitched for international investments. India reportedly secured commitments worth 20 trillion rupees at the event, reports N. Madhavan in today's Mint Primer. The real challenge here is converting these pledges into actual investments. Experts say even a 50% realization rate is a success. Some states have set up high-level committees to track progress. But critics argue that such summits often shift investments between states rather than attracting fresh capital. Now, beyond numbers, these summits sharpen competition, push states to improve business policies, and give investors a platform to network. However, real investments depend on execution, regulatory ease, infrastructure, and political stability. For now, India's investment race is heating up. Whether it delivers remains to be seen. The tobacco industry in India is under strain as soaring tobacco leaf prices squeeze margins, with little relief expected in Q4 FY25. Over the past 7 months, prices have surged 20%, tightening profitability for cigarette makers like ITC, which saw a 211 basis point drop in its cigarette EBITDA margin in Q3 FY25. Despite these pressures, cigarette makers have managed to sustain volume growth, reclaiming market share from the illicit segment, which still accounts for about 25% of India's tobacco market. A mix of stable taxation, stricter enforcement against illegal trade, and premiumization has supported legal cigarette sales. ITC cigarettes revenue grew 8% year-on-year to 8,940 crore rupees, while Godfrey Phillips saw a 27% jump to 1,896 crore rupees. Marlboro's rising popularity among young smokers has strengthened Godfrey Phillips' market position, helping it defy margin contraction trends with a 440 basis point increase in operating profit margin to 22.6%, reports Abhinava Saha. However, looming tax uncertainties cast a shadow on the industry. Speculations about a GST hike to 40% has rattled investors, raising concerns about a potential shift back to illegal cigarette consumption. While cigarette taxation currently stands at around 53%, any hike in excise duty alongside a GST increase could put further strain on margins and demand. With the compensation cess set to end in 2026, the government may adjust GST to maintain revenue streams, especially after recent tax cuts for the middle class. For now, tobacco firms must navigate input cost inflation and cautious pricing strategies to sustain profitability. India's small-cap mutual funds are facing mounting liquidity risks, with some top funds now requiring over 50 days to liquidate half their portfolios, according to the latest stress test data. The Securities and Exchange Board of India, SEBI, mandated tests highlighted growing challenges as investors continue pouring money into these funds drawn by high return potential. On an average, the time needed to liquidate 50% of a small-cap fund has jumped by nearly 40 days over the past year, while the 25% liquidation period has extended by almost 20 days. Larger fund sizes and rapid inflows are making it harder for fund managers to maintain their original investment strategies, sometimes forcing them to dilute their portfolios with mid or large cap stocks. To manage liquidity, many funds have adopted a soft close strategy, restricting new inflows to existing investors or SIPs. Despite concerns, industry experts note that small-cap investing inherently carries liquidity risks. While these funds provide diversification and professional oversight, some funds with extreme liquidity constraints may have exposure to lower quality stocks. Retail investors are advised to maintain a balanced allocation, keeping small-cap exposure within 10 to 20% of their overall portfolio. Analysts caution that overexposure to small caps could leave investors vulnerable to market swings, particularly amid ongoing volatility, reports Anil Poste and Neil Borat. Despite liquidity concerns, investor enthusiasm remains high. However, with SEBI stress tests flagging increased exit challenges, regulators may soon need to step in to prevent potential liquidity mismatches in this booming segment. Vedanta Limited has secured shareholder and creditor approval for its much-anticipated demerger, paving the way for the creation of 5 independent companies. The restructuring, expected to be finalized by Q1 FY26, aims to enhance agility and unlock value for investors. Initially planned a 6-way split, Vedanta will now retain its base metals unit, considering a spin-off only after the business matures. The 5 new entities will include Vedanta Aluminium, Vedanta Oil and Gas, Vedanta Power, Vedanta Iron and Steel, Vedanta Limited. Existing shareholders will receive stakes in each of the 5 new firms, allowing sector-specific investment choices. The plan, backed by 99.99% of shareholders, now awaits regulatory approvals. Vedanta's Q3 FY24 results showcased robust performance, with revenue rising 10% year-on-year to 385.3 billion rupees and net profit surging 76% to 35.5 billion rupees. EBITDA also grew 30%, driven by cost optimization and higher production. While full-year revenue dropped slightly, the demerger is expected to streamline operations and attract specialized investors, positioning Vedanta for long-term growth. India is shifting gears in its pharmaceutical industry, moving beyond generic drugs to become a hub for innovation. To accelerate research in drug discovery, medical technology, and stem cell therapy, the government will invite Expressions of Interest (EOE) in March for a 5,000 crore rupee fund initiative. Bid submissions are expected in April. This initiative falls under the Promotion of Research and Innovation in Pharma Medtech Sectors (PRIP) scheme, launched in August 2023 for 5 years. The aim? Boost domestic R&D, reduce reliance on imports, and support startups and major pharma firms investing in cutting-edge research. The government has allocated 4,250 crore rupees for industrial research, with startups eligible for 1 crore rupees and larger companies securing 100 to 125 crore rupees per project. The push comes as India seeks to strengthen its pharma supply chains and transition from a generic drug powerhouse to a leader in high-value innovation. While Indian pharma firms dominate US generic drug sales, accounting for 47% of all generic prescriptions in 2022, growth is slowing due to its rising competition and expiring patents. India's R&D investment remains low at just $3 billion annually, compared to that of $50 to $60 billion in the US and $15 to $20 billion in China. The PRIP scheme aims to bridge this gap by driving industry-led research and fostering collaboration between academia and businesses. Additionally, the government will establish centers of excellence across 7 pharma institutes, focusing on specializing research areas such as biopharmaceuticals, biosimilars, stem cell therapies, medical devices, and antimicrobial resistance. Experts welcome the funding, but stress that the regulatory reforms and stronger public-private collaboration will be key to India's success in the pharmaceutical innovation. That's all for today. Thank you for joining in. I'm eagerly looking forward to our next Top of the Morning episode, which will be packed with the latest business news. Until then, this is Nelson John signing off. Have a wonderful day.